Hello and welcome back to another edition of Lipper's Fund Flows Inside. I'm Matthew Lemieux. Also, welcome back from your holiday. Hope everyone had a happy Thanksgiving. Today we're going to be looking at the fund flows for the week ending November 21st. And kind of building up to the week before Thanksgiving, there was really concern in the market. We had seen 7 days after the U.S. presidential election. Most of the equity markets in the U.S. were down across the board about 5.5%. A lot of people were pointing to concerns over the fiscal cliff, or maybe they just kind of got their attention back on to some of the earnings reports. We saw really a lot of revenue misses come in and maybe some outlooks not looking so good. So investors really kind of getting their eye back on the ball and showing some concern out in the market. So basically through that week, 5.5% down. But really what a difference a day can make. Last Friday, the word came out that the president had met with the congressional leadership. First steps looking positive towards alleviating this issue on the fiscal cliff starting January 1st. And ever since that point, even through last Friday, we basically made up most of that ground that we had lost. So investors now kind of looking at the holiday season, going into the shopping season. We did see, this morning being Monday, we did see that record numbers of Americans were out opening their wallets either online or in stores shopping. So hopefully that'll be a bright spot for the retail sector going forward. So let's actually take a look at how this holiday week played out in the fund flows numbers. If we actually look at the macro groups, we saw overall $19.1 billion into the conventional mutual fund business. Of course, if you look down at the bottom right off the bat, 20.5 of that was coming in from money market funds. So overall, we were somewhat net negative. Aside from that, equity funds pushed out $2.9 billion for the week. Taxable bond funds brought in just about $500 million for the week. And muni debt continued to do strong at about $1 billion of inflows for the week. So here's the big story again, equity funds. We saw it last week, we saw it this week. Actually, this is the second consecutive week of pretty heavy outflows for equity mutual funds. If you actually look at the 2 weeks together, this week at 2.9, plus last week, we're seeing around 4.5 billion going out. If you look at it, again, most of the bleeding is coming from the domestic side, $3.3 billion. And if you take a little bit more granular look, it's large cap funds and S&P 500 index funds, really taking up the slack and making up for most of those outflows. Investors just really weary of that sector, especially domestically. Non-domestically, we continue to see some strength, even though it was quite low, 377 million. Vast majority of that coming from interest, continuing going into emerging market equity investors looking for the growth story, continue to allocate cash into that part of risk. But overall, equity outflows, and I think as we kind of look at the bigger picture here, we're going to kind of see a little bit of a move toward a risk-off position. Let's go to the ETF side though, because sometimes we often see a different story. Not this week. This week we saw the same story, outflows going across the board, $4.4 billion out of equity ETFs. And again, the big culprit usually is SPY, Spider SP 500. This week, 2.9 billion out, but they weren't the only ones. If you look at IWM or the Russell 2000 product, they saw about $920 million out. And again, kind of coming back to that story, we're going to build a little bit more towards safety, a little risk off. We actually saw money going into GLD or Spider Gold Trust, about $350 million. So money out of equity, we're seeing a little bit of money going into gold. So let's take a look at the next group, which is taxable bond funds. Taxable bond funds, even though they had inflows this week, about $500 million, really quite low. It is their third consecutive week of inflows, but if you look at their moving average, their 4-week moving average, it's about 1.3 billion a week right now. And that's the lowest that we've seen since I believe the beginning of August. So we've seen kind of a slowdown. Part of that story may be, risk-off situation. Part of that story may be we're just getting to the holiday season, the end of the year, maybe less allocating of cash going that way. But overall, $500 million. But again, very similar to last week, it was a tale of two cities here. We've always been talking about the differences, especially in this group, between the investment grade corporates and the high yield corporates. And just like last week, we see investors flocking to the investment grade. They're looking for the higher quality, $1.3 billion going into that group. But then if you look on the other side of the coin, the high yield, continued outflows there, about $1 billion in outflows. This is the second consecutive week for high yield. So investors really taking some risk off on the higher yield products, feeling more comfortable in the investment grade. The other group of note would be mortgages. They've been doing quite well, actually 51 consecutive week of inflows for that group. This week, they make it $315 million. So onto the taxable bond ETF story. Very quiet once again, about $201 million into that group. If you look at the numbers, I kind of highlighted just the play. We saw kind of a different play between HYG and J&K. HYG pushing money out, J&K bringing money in. I think really the underlying story, if you looked at the data at the bottom, you'll see that treasuries did quite well. Again, another direction of pointing towards safety. $616 million going into treasury-based products. You do see on the chart, you see TIP or the iShares TIPS products brought in about $111 million. But if you also look at the 1 to 3 month T-bill from Spider, and then also look at the 7 to 10 year Treasury from iShares. We saw some money going into those as well. So again, still kind of coming around this story that investors are taking risk off, feeling a little bit more comfortable on the sidelines. Third group we're going to look at is municipal debt. Municipal debt has done very well this week, again, just under about $1 billion of inflows. If you actually look at the split out, national muni is about $800 million, and people still going high yield. They feel comfortable in the high yield muni space, $247 million. One of the big stories we really think is that there is some concern out there that towards the end of the year, or whenever this grand bargain comes around with the fiscal cliff, somebody, investment income is going to take a hit. We're going to see increases in investment income rates. So people are feeling much more comfortable going towards the tax haven or the tax relief that they're seeing from the municipal bond space. So we continue to see that going forward. If you actually look at the year, we had a little bit of a hiccup back in Sandy towards the end of October, and one previous to that. We've only seen 2 weeks of outflows so far in 2012. So that's really quite a remarkable number, and I think we'll continue to see investors go towards municipal debt through the end of the year, at least until we kind of see some more clarification on what's going to come out in this fiscal cliff deal. The last group we're going to look at is money market funds. We said, again, money market funds brought in big inflows, $20.5 billion. Again, investors kind of going toward the sidelines, but we like to look at the difference between the institutional and the retail, and I thought it was kind of telling this week. Really, we saw institutional money, even though we saw inflows to both. Institutional, we saw about $6.8 billion, retail about $13.7 billion. So maybe part of this flight to safety is anticipation of higher volatility. There really is some concrete concern out there over the fiscal cliff. We do get flashbacks of the previous debt ceiling debacle where markets took a big hit. We saw a lot of volatility coming from that. So a lot of investors towards the end of the year, they may just feel, hey, we got December coming. Last year, December was very flat, not very much going on. Maybe we'll just feel a little bit more comfortable standing on the sidelines till the year end, until we get maybe a deal going through. See how these holiday shopping numbers come out, and kind of maybe get a better picture of what 2013 has in store for us. So that's what we're going to be looking for, I think, over the next few weeks until the end of the year. We're going to talk about the fiscal cliff. I think we're going to talk about Greece, because we're still kind of seeing that there's some issues there on getting the next allotment of money agreed upon. And we've also heard some concerns in Japan as well, but I think a lot of investors are going to be saying, how are we going to look through December? How is the retail season really going to shape up? And are we going to see some serious discussions coming out of Washington for the policymakers? So if you really kind of want to get a better, maybe a little bit of deeper dive to this data, you can visit the website. It's www.lipperusfundflows.com. You can go there, try to take a deeper dive, or you can meet us again next week where we'll go over the numbers. Once again, my name is Matthew Lemieux, and this is Lipper's Fund Flow Insight Desk.